Let's start with a hard truth that the financial industry spends billions of dollars trying to hide from you. The investment business is a giant scam of subtraction. We've been conditioned to believe that in life, you get what you pay for. If you buy a more expensive car, it's usually faster. If you hire a more expensive surgeon, they're usually more skilled. But in the world of investing, the more you pay the experts, the less you keep for yourself. John C. Bogle, the legendary founder of Vanguard, blew the whistle on this nearly 2 decades ago in the little book of Common Sense Investing. He didn't just write a book, he started a revolution. He wanted to show the average person, the teacher, the plumber, the office manager, that they could actually outperform the titans of Wall Street by doing absolutely nothing. Today we're breaking down the mechanics of how that works and why common sense is the rarest commodity on the trading floor. The math of the loser's game. To understand Bogle, you have to understand the difference between a winner's game and a loser's game. In a winner's game, the outcome is determined by the correct actions of the winner. In a loser's game, like amateur tennis or the stock market, the outcome is determined by the mistakes of the loser. Most investors lose because they try too hard to win. They trade too often, they pay too much in commissions, and they chase hot stocks that have already peaked. Bogle argues that the stock market as a whole is a zero-sum game before costs. For every investor who buys a stock that goes up, there's another who sold it. But after you factor in the brokers, the hedge fund managers, and the taxmen, it becomes a loser's game. The only way to win is to stop playing their game and start owning the entire field. The power of the haystack. You've heard the old saying about finding a needle in a haystack. In the investment world, that needle is the next Amazon, the next Google, or the next star manager who can predict the future. Bogle's advice is brilliantly simple. Stop looking for the needle. Just buy the whole damn haystack. When you buy a low-cost S&P 500 index fund, you are buying a piece of the 500 most successful companies in America. You own the technology of Apple, the retail dominance of Walmart, and the healthcare innovations of Johnson & Johnson. You don't have to guess which one will win next year because as long as the American economy grows over the long haul, you win. This is indexing, and it's the ultimate expression of financial humility. You're admitting you don't know more than the market, and ironically, that admission makes you wealthier than those who think they do. The silent killer. Compounding costs. Now let's talk about the tyranny of costs. This is the section of the book that makes Wall Street executives sweat. We all know about the magic of compounding interest, where your money makes money, and that money makes more money. It's the eighth wonder of the world. But Bogle introduces us to its evil twin, compounding costs. Imagine you have a $10,000 investment. If the market returns 7% and you pay 2% in fees to a managed fund, you only keep 5%. Over 50 years, that 2% fee doesn't just take 2% of your profit. It can literally wipe out 60% to 70% of your total potential wealth. You're the one taking all the risk, you're the one providing the capital, yet the helpers are taking the majority of the rewards. Bogle's relentless rules of humble arithmetic prove that in investing, you get what you don't pay for. The myth of the star manager. We love a hero. We want to believe there's a wizard in a suit in a Manhattan skyscraper who knows exactly when the market will crash and when it will soar. Bogle dismantles this myth with cold, hard data. He shows that star managers almost always revert to the mean. A manager might have a brilliant 5-year run due to sheer luck or a specific market trend, but eventually the law of gravity kicks in. Most of these stars burn out, and today's top-performing fund is statistically likely to be tomorrow's basement dweller. When you pick an active manager, you're betting that they can beat the market after charging you high fees. The odds are stacked against them and you. Bogle's message is clear. Don't pick the jockey, just own the track. Speculation versus enterprise. Bogle makes a critical distinction between investment and speculation. Investment is the long-term process of reaping the rewards of corporate earnings and dividends. Speculation is the short-term attempt to guess what someone else will pay for a stock tomorrow. The stock market is a weird place where the price often has nothing to do with the value. In the short run, the market is a voting machine, fueled by emotions like greed and fear. But in the long run, it's a weighing machine that only cares about how much money businesses are actually making. If you focus on the speculative return, the change in PE ratios, you'll have a heart attack every time the news cycle turns sour. If you focus on the investment return, dividends and earnings growth, you realize that the fundamentals of the economy are remarkably stable. The tax man cometh. One of the most overlooked advantages of Bogle's common sense approach is tax efficiency. Active fund managers are constantly buying and selling stocks. This is called turnover. Every time they sell a winner to try and find a new one, they trigger a capital gains tax for you. You're losing money to the government before you even see it. Index funds, however, have very low turnover. They only sell a stock if it drops out of the index. This allows your money to sit and compound undisturbed for decades. Bogle calls this a hidden dividend. By being lazy and holding your stocks, you are effectively keeping the IRS at arm's length for as long as possible. In the game of wealth, it's not what you make, it's what you keep. The allure of new fads. Every few years, the financial industry invents a new, shiny object to sell you. Whether it's sector funds, thematic ETFs, or complex derivatives, Bogle warns us to stay away. These products are created for one reason: to be sold, not to be held. They capitalize on your FOMO, the fear of missing out. You see your neighbor making money on a specific tech sector or a new commodity, and you want in. But by the time these specialized funds are marketed to the public, the easy money has already been made. Bogle's philosophy is boring is better. If your investment strategy feels like watching paint dry or watching grass grow, you're probably doing it right. Complexity is the enemy of the individual investor. Reversion to the mean. Let's talk about the most powerful force in finance: reversion to the mean. This is the idea that everything eventually returns to its average. If a sector of the market is doing exceptionally well, it will eventually do poorly. If a manager is a genius today, they will likely be average tomorrow. Bogle uses this to explain why chasing performance is a recipe for disaster. Most people buy into a fund after it has had a massive year, and they sell it after it has had a terrible year. They are essentially buying high and selling low. By holding a broad index, you don't have to worry about which sector is hot. You'll own the hot sectors when they rise, and your diversified base will protect you when they inevitably cool down. The dividend secret. Many people look at the stock market and only see the price of the S&P 500 going up or down. But Bogle points out that a huge portion of your long-term wealth comes from dividends. Over the last century, a massive chunk of the total return of the stock market came from companies simply paying out a portion of their profits to shareholders, and those shareholders reinvesting that cash. When you own the whole market, you are tapping into the collective yield of the American corporate world. These dividends act as a buffer during market downturns. Even when stock prices are falling, companies are often still paying dividends, which allows you to buy more shares at a discount. It's the ultimate buy low machine, and it happens automatically in an index fund. Time is your greatest ally. Bogle's strategy requires one thing that most people lack: patience. He explains that time is the friend of the humble investor, but the enemy of the speculator. In a 1-year period, the stock market is a coin toss. It could be up 30% or down 20%. But as you extend your time horizon to 10, 20, or 30 years, the probability of losing money in a diversified index fund drops towards zero. The common sense approach isn't about getting rich quick, it's about getting rich surely. Bogle encourages us to stay the course. When the headlines are screaming about a recession or a crash, that's when your discipline is tested. If you can survive the emotional volatility, the math of compounding will take care of the rest. Selecting your asset allocation. So how do you actually do this? Bogle doesn't leave you hanging. He suggests a simple balance between stocks and bonds. Stocks provide the growth, while bonds provide the ballast to keep your ship steady during a storm. Your common sense portfolio should reflect your age and your ability to stomach risk. If you're young, you can afford to have more in stocks because you have decades to recover from a crash. As you get older, you shift toward bonds to protect what you've built. You don't need a complex algorithm to figure this out. A simple total stock market index and a total bond market index are all most people will ever need to achieve financial independence.